Hello, all. Good evening and welcome. I am Mamta Rawat from the corporate communication team of CareEdge. I welcome you to our discussion today on Indian hospitality industry, room for more growth. We sincerely appreciate your time in joining us for this webinar. We would like to welcome our esteemed guest speakers for today. Mr. Ankur Dalwani, Chief Financial Officer and EVP at Indian Hotels Company Limited. Mr. Pankaj Madan, Group Chief Financial Officer at InterGlobe Enterprises. Mr. Rattan Keswani, author and consultant and ex-deputy managing director at Lemon Tree. This session will be moderated by Sabyasachi Majumdar, senior director, and Ravleen Sethi, director at CareEdge Ratings. We will commence the session with the presentation by Sunidhi Vyas, lead analyst at CareEdge Ratings. This will be followed by a panel discussion and Q&A session. In case of queries, participants are requested to key in your panel. We will take up your queries at the end of the discussion. Now, may I invite Sunidhi to make the presentation.
Thank you, Mamta. So, good evening, everyone. We'll start with the presentation. The Indian hospitality sector is currently in its upcycle, where the growth has been driven by favorable demographics, robust domestic demand, with supply clearly lagging the demand growth, increased investments, and ongoing improvement in infrastructure and connectivity. Encouragingly, the demand outlook for the Indian hospitality industry, even in fiscal year of 2025, remains positive. But is there room for more growth as we head forward from here? With this thought in the backdrop, we at CareEdge have put up a presentation to share our view on the sector. We are covering the entire presentation in three parts, wherein we'll first take you all through the trends in travel and tourism sector as it is inextricably linked to the hospitality sector. We'll then move to the key trends in India hospitality sector, and thereafter we shall have a look at the credit profile of hotel players and CareEdge ratings outlook. To set the context for the flow of presentation, the key messages are that demand continues to remain strong. Amid the healthy demand, the average occupancy levels for the branded space are expected to sustain at 67 to 69%. Domestic travel has been a significant contributor to the growth in this sector, with international travel picking up but remains exposed to geopolitical factors. With this, industry's key performance indicators have registered growth for 2 consecutive years. Revenue for the industry, even in FY25, is expected to register a growth rate of 8 to 9%, which will well be supported by supply clearly lagging the demand growth rate in the medium term, benefiting players. Here, we'll also talk about the inventory segmentation tilting towards mid-scale and upper mid-scale. The credit profile of players has improved and is expected to sustain going forward. Let us now take a closer look at these key messages. Indian economy currently ranks 9th in the world in terms of total absolute contribution of travel and tourism sector to world GDP. Here in Exhibit 1, the dark blue bars represent the absolute contribution of travel and tourism to India's GDP in USD billion calendar year wise, and green line is the year-on-year percentage contribution that travel and tourism sector contributed to India's GDP. Operating in a highly cyclical industry and exposed to discretionary spends, there have been significant variation in its total contribution through an economic cycle, and contribution is range-bound in pre-COVID era to about 180 to 200 billion USD. In 2019, the contribution was about 7.5% of the nation's GDP. However, in 2020, a considerable decline was witnessed, which can be attributed to the stringent lockdown imposed during the COVID-19. After a devastating 43% fall, it also recovered by 46% in 2021, boosted by successful vaccination drive and strong pent-up demand. And in year 2023, the same registered further growth and surpassed the pre-pandemic spend levels. In the light of the impetus on the sector by government with new tourism policies, additional airports, infra push through roads and highways, it is anticipated that the Indian travel and tourism sector shall grow by 8 to 9% annually on an average, reaching a total value of USD 500 to 530 billion and contribute significantly to the total GDP over the next 1 decade. Here we are showing the international tourist arrivals around the world. The green bars in Exhibit 2 and 3 represent world international tourist arrivals in millions in each of the calendar years and world tourism receipts in USD billion respectively. And blue line in both the exhibits represents India's share in world total. Numbers in green circles represent India's rank in world. International tourist arrivals in world, which stood at around 1465 million in 2019, plunged to 407 million when COVID had struck and remained in that range in 2021 due to continuous travel restrictions. With relaxation of restrictions and increase in demand for travel, traffic more than doubled year on year in 2022 and stood at 65% of pre-pandemic levels. International traffic was only 11% below the pre-pandemic levels by the end of the calendar year 2023. An interesting fact and trend which has emerged here is that India ranks 14th in terms of the international tourist arrivals in the world as of 2022, and in pre-COVID era this was 25th rank, which is also significantly up from rank of 15 2003. A similar trend can be seen in Exhibit 3 as well, where international tourism receipts surpassed USD 1480 billion mark in 2023, growing almost 29% year on year and surpassing the pre-pandemic spent levels. Also, in terms of world tourism receipts, India's rank has improved significantly and currently stand at 14th. Factors such as government push to tourism, adoption of e-visas and on arrival visa, enhanced medical tourism, and comparatively weaker currency for international tourists have enabled the country to make its position in the world tourism. With India's share of this sector increasing as projected, India's rank in world total shall further improve. Here in Exhibit 4, domestic air passenger traffic quarterly has been depicted for last 5 fiscals in India. Likewise, in Exhibit 5, similar data for FTAs in India has been depicted. Due to COVID disruptions, the air passenger traffic in FY21 witnessed a steep decline, and since the restrictions continued in 2021, there was not much recovery even in FY22. India resumed all regular international flights with full capacity in March 2022. Domestic air passenger traffic grew by 62% in FY23 and 13% year on year in FY24 and has surpassed pre pandemic levels. FTAs grew by 17% year on year in FY24 and is only 10% short of pre pandemic levels of close to 10.6 million arrivals in a fiscal. The premium hotel industry in India is highly dependent on foreign traveling, both the segments, including business and leisure. Now we come to the trends in the hospitality sector. In Exhibit 6, the light blue bars are average room rates, dark blue bars are the revenue per available room, and green line is the occupancy levels. We have tried to segregate this period into different phases since fiscal 2003. The Indian hospitality industry witnessed a boom period during fiscal year 2003 to fiscal 2008, marked by rising occupancy levels and average room rates, with RevPARs growing in each of the years. Thereafter, the sector got impacted by the recession phase of 2008, which was then impacted by the double whammy of a fall in demand and a strong supply addition. While the sector witnessed some revival after fiscal 14, with moderate demand growth until fiscal 20, it was significantly impacted during the pandemic. It was the worst period in the history of the hospitality sector, with RevPARs declining by almost 66 to 70% from FY20 levels. However, the sector made a steady recovery in FY22 as successful vaccination drives and reduction in COVID cases helped improve travel sentiment. FY22 has witnessed a sharp rebound in RevPAR, and in FY23, industry registered a further growth, and these stood at 9% over the pre-pandemic level, which grew further by 14% in FY24. Recovery post-COVID has pushed the sector now in its growth phase. In FY25 as well, with confluence of positives, occupancy, and average room rates are expected to register growth over FY24 levels, hence supporting the credit profile of players. Our estimates is that RevPAR growth of 8 to 9% in FY25 over FY24 levels. Now let us look at ARR and occupancy trends in major cities. In the first chart, we can see that Mumbai had the highest occupancy level at 78 to 79%, followed by Delhi with occupancy at 72 to 74% in FY24, which is similar to pre-pandemic occupancy levels for both the cities. Mumbai had ARR of 9,500 to 10,500, which is the highest amongst urban markets due to improved business sentiment and corporate travel. However, we can see that Udaipur had clocked the highest ARR due to large base of upper upscale and luxury hotels, though city had the lowest occupancy due to its reliance on weddings, which is a seasonal market. Major gateway cities are expected to clock higher growth in FY25 due to improved business sentiments and corporate travel. Now let us look at the key demand drivers. Leisure continues to remain strong demand driver, and leisure as a trend continues in FY25. The gap between tier 3 and tier 2 markets in terms of RevPAR is reducing over the years. These are predominantly leisure locations or popular due to faith tourism. MICE and business travel is expected to double its share in next 5 years. In recent years, India has witnessed emergence of convention centers which has facilitated large-scale MICE events. Global events such as G20 and ICC have enhanced international visibility. The country is aiming to host international sporting events like the 2029 World Athletic Championship, 2030 Youth Olympics, and 2036 Summer Olympics. FTAs have registered strong growth in FY24 and is expected to cross pre-pandemic levels in FY25. They, however, remain exposed to geopolitical factors. Weddings are fueled by rising income levels, which are expected to gain further momentum. Favorable demographics, mid-scale hotel segment with tier 2 pacing up, as well as government's focus on infrastructure and connectivity development continues to be key drivers. In Exhibit 8, the green bars represent branded room inventory of hotels over the year, and grey-blue line is the year-on-year growth in supply. Period marked from FY13 to FY16 or 17, the supply increased significantly in the branded room space, and with lower occupancies, it added to the woes of the sector, resulting into down cycle. Thereafter, there was a steady recovery, but in fiscal 21, supply was at multi-year low as the hospitality industry practically came to a halt with the outbreak of COVID. Poor financial position of players, uncertainty over resumption in travel led to delays in project completion, which were under implementation. And these were resumed by players in fiscal 22, leading to reasonable supply growth thereafter in 2022 and 2023. India has about 166,000 branded hotel rooms by end of fiscal 23. The industry is expected to add a capacity of approximately 55,000 rooms by fiscal 28, with supply registering a CAGR of 4.5 to 5.5% in the said period. The growth of chain affiliated supply will also occur through conversions that may be signed and implemented over a shorter period. Demand is, however, expected to grow in 8 to 9%. Exhibit 9 below shows the percentage share of each segment in the branded room inventory in fiscal 15, 23, and how will the fare mix in fiscal 28 when the planned supply about which we just talked about will be added. Presently, supply is more balanced across different segments as compared to an earlier mix that was heavily weighted towards luxury and upper upscale hotels. The supply concentration in the luxury and upper upscale segment is expected to reduce further, as can be seen in green bars, which represent fiscal 28. This is majorly due to higher share, roughly about 67% of new supply coming in upper mid-scale and mid-scale or economy sections. The industry dynamics has witnessed a significant shift from investing to exploring the multiple asset-light options, which help in increasing the revenue and margins without major capital expenditure. Having talked about supply at pan-India level, we'll quickly walk you through the supply in key markets in Exhibit 11. Bengaluru with 18,600 plus and Mumbai with 18,000 plus have the highest number of room inventory, followed by New Delhi, which has 15,000 plus. Bengaluru and Mumbai are seeing good traction in the upcoming supply. In absolute terms, Goa has seen the maximum growth in recent years. Gurugram and Navi Mumbai have seen a moderate increase in their supply, but these markets are upcoming commercial hubs, which are likely to witness an increase in the number of offices and businesses operating out of them. About 15 to 20% of the total branded hotel room supply in India is coming at key leisure destinations. With creation of a robust demand base, the upcoming supply pipeline currently shows a clear correlation vis-à-vis the upcoming tourism and infrastructure developments. We now move to the credit profile of players and CareEdge rating outlook. Hotel revenues are highly cyclical in view of the demand-driven, price-elastic business model, as well as the lumpy supply-side dynamics. In Exhibit 11, green bars present revenue in rupees crore for a sample set of listed players, and blue line is the year-on-year growth in revenue. From the period FY17 to FY20, revenue for these sample set of players were in the range of 15,000 crores. Fiscal 21 witnessed sharp decline in revenue profile of players when, apart from the room revenue, players also lost significantly on the food and beverages, which typically contributes 35 to 40% of top line. The performance of these players improved significantly in fiscal 22 with a V-shaped recovery due to vaccination and improvement in travel sentiments, and revenue got reinstated at pre-COVID levels. With strong recovery in occupancy and surge in room rates, the sector experienced a reversal of fortunes in the fiscal 23 with 66% year-on-year growth in revenue, and for these sample set, the same stood at 22,000 crores. FY24 was another remarkable year, which registered a 19% rise in revenue profile. Given the strong demand tailwinds, CareEdge estimates further surge in the revenue profile of the industry in the range of 8 to 9% year-on-year in fiscal 25. In Exhibit 12, the blue bars represent the operating margins trend from FY17 to 20, which were range-bound in 18 to 19% for the sample set of players. The sharp decline in revenue profiles due to COVID, coupled with the escalating cost structures, precipitated significant operating losses for the sector during fiscal 21. During 2021 and 2022, industry players did a comprehensive cost containment drive. As revenues improved amidst continued cost control, the industry posted profits at the operating level in the fiscal 22, though lower than pre-COVID levels. In FY24, not just the revenue grew to a decadal high for the sector, but also operating profitability registered a significant increase and stood at 25 to 26%, which is a substantial leap of 700 bips compared to pre-COVID level. This positive momentum is anticipated to persist over the next 2 years as the sector propels forward with lower supplies and strong demand tailwinds. Employee cost, which is the major cost, has reduced significantly compared to pre-COVID levels, but is now on the rise. Corporate overheads are also expected to increase in the medium term in the midst of ongoing capacity expansions. Any sharp decline in the key performance indicators owing to macros environment or exogenous factors and significant surge in cost remain a downside risk to our assumption. With improved revenue and profitability profiles, leverage and coverage indicators also improved as indicated in the current slide. Debt to EBITDA in pre-COVID era averaged at about 4 to 5 times, and with rising debt and falling profitability leverage, deteriorated in fiscal 21 and 22. With this significant increase in profitability in fiscal 23, players were able to pare the debt levels, and debt to EBITDA indicator improved to 2.7 times, which is improvement over the pre-pandemic levels. Similar is the case with interest coverage indicators, which used to hover around 2 times in pre-COVID years and witnessed a dip in FY21 and FY22, improved in FY23. With sustenance in operating profitability, these parameters are expected to sustain. In Exhibit 14, return on capital employed for the sample set of players is depicted. Historically, the ROCE has been around 5% for the industry average. The same has significantly improved in FY23 and 24. With improved financial matrix, the credit ratio for the sector, which is calculated as upgrade to downgrade ratio, also witnessed stark improvement and stood at 9 times as depicted in Exhibit 15. FY21 and FY22 were the years where significant amount of downgrades happened owing to worsening operating metrics and stretched liquidity for few players, which is visible in low credit ratio. Exhibit 16 represents rating dispersion for CareEdge rated players in the sector. 44% of rated entities, which have about 18% of debt that CareEdge rates, is in below investment grade. These are largely all smaller players. 56% of rated entities with 82% of rated debt is in investment grade. Having talked about the industry dynamics and credit profile of the players, let us look at emerging trends and driving factors in the sector, and here we'll also briefly touch upon the key monitorable. Among the drivers or emerging trends, healthy demand is expected. Clear focus on infra and tourism by the government, including airports and roads, will attract a lot of tourists and boost tourism and hospitality sector. Asset light model is gaining traction. Rebranding is happening, which is adding to the organized supply in the sector. Amongst the monitorable, sector currently is in a sweet spot, but macro and geopolitical factors may affect demand in some markets. Also, for the margins to sustain at projected levels, continuation of the cost containment measures by hoteliers even after the strong demand is the key. Moderate supply in FY25 to keep occupancy buoyant, sustenance of high ARRs when new supply starts kicking in is monitorable. Also, the operating performance of the sector remains vulnerable to cyclicality or seasonality, along with macroeconomic cycles and exogenous factors. Hence, all of these shall continue to be the monitorable. With this, we come to the end of our presentation. Thank you, everyone. I hand it over back to you, Mamta.
Thank you, Sunidhi. Attendees are requested to key in their questions, which we will take up after our panel discussion. Now, may I invite Sabyasachi Majumdar and Ravleen Sethi to take over the session, please. Sabyasachi Majumdar is a Senior Director at CareEdge Ratings. He has over 25 years of experience in credit rating and sectoral research across diverse sectors such as power, renewable energy, cement, sugar, chemicals, oil and gas, etc. He is an alumnus of IIM Lucknow and Delhi College of Engineering. Ravleen is a director with CareEdge Ratings. She is a qualified chartered accountant with an honors degree from Hansraj College. Ravleen has over 13 years of experience in the industry, with more than 8 years in ratings. At CareEdge Ratings, she looks after the credits of large corporates and has expertise in handling diverse sectors, including hospitality. Over to you, Sabyasachi and Ravleen.
Yeah, thank you so much for the introduction. First of all, warm welcome to all the participants. And I would like to specially thank our three distinguished panelists who have taken time, their busy time out for, uh, joining our webinar. And I'm sure all of us, including us, will be benefited much from the insights and experience in this particular sector. So and also I'd like to thank Sunidhi for a wonderful presentation which sets the context very beautifully for our discussions. So, without any further ado, let me get into the questions. My first set of questions are, pertaining to demand, and I would begin by asking Mr. Dalwani this question. Mr. Dalwani, what, as per you, is the uh, brief introduction to all the panelists. I'll start with the introduction in the alphabetical order. First of all, we have with us Mr. Ankur Dalwani. Mr. Ankur is the Chief Financial Officer and EVP at Indian Hotels Company Limited. He's a seasoned finance professional with experience of more than 27 years across the corporate finance and strategy, mergers and acquisitions, business planning, spanning multiple sectors. He joined IHCL from Group CFO's office in Tata Sons, where as VP, he worked closely with group companies on strategic business planning, value enhancement strategies, and business performance management. Prior to the Tata Group, Ankur led the real estate lending business at L&T Financial Services. Previously, he has also held other notable positions as President Corporate Strategy at Aditya Birla Group and senior level positions at leading investment banks such as Jefferies India, IDFC Capital, and DSP Merrill Lynch. Welcome, Ankur. Next, we have with us Mr. Pankaj Madan. Pankaj is a group CFO of InterGlobe Enterprises. He's a vital part of the leadership team and serves on the executive committee of InterGlobe Enterprises, as well as on the board of various group companies. Before his current role, Pankaj gathered over 27 years of experience as the CFO of prominent organizations such as Indigo Airlines, Bharti Walmart, Cargill Thailand, and Telstra Singapore and India, where he was in charge of all facets of finance function, leading businesses amid strong competition and providing adept captainship to multifunctional global teams. Pankaj obtained his chartered accountant degree from the Institute of Chartered Accountants of India MBA from Deakin University in Australia, and LLB and BSc Physics from Delhi University. Additionally, he has also attended several senior leadership executive programs at leading business schools worldwide. Welcome, Mr. Madan. Finally, we come to Mr. Rattan Keswani. He's an industry expert. He was an ex-deputy managing director with Lemon Tree. He's also the author to the book Check In, Never Check Out. Mr. Keswani began his career over 40 years ago in 1981. He has worked in different roles and countries with a myriad of experiences. From his tenure at Oberoi Hotels and Resorts, where he ascended to the role of president at Trident Hotels, to enriching experiences in partnership with renowned hotel groups like Sheraton, Intercontinental, Hilton, finally culminating as the deputy managing director at Lemon Tree Hotels and co-promoter and director of Carnation Hotels. He has received various awards and accolades in his career as a renowned figure in hospitality industry. He is currently an independent consultant and also on board of the Manav Rachna University. Welcome, Mr. Keswani. I would like to, begin with some questions on demand to all the esteemed panelists. My first question is addressed to Mr. Dalwani. What, as per you, is the expected growth rate in demand for FY25? Particularly, given that, Q1 was soft due to elections and heat waves. So how is the current quarter from the industry perspective shaping up? And of course, this will be city and specific. If you can add some color on that front to the same. And do you see global headwinds or inflation being roadblocks to the demand growth which is expected? Over to you, Mr. Dalwani.
Thank you, Sabyasachi, for the introduction. And I think it was a very interesting presentation. I must thank you for that and the entire CareEdge team. So, from a industry perspective, as we see the sector, I think firstly, I think there are structural trends which I think you also referred to in the presentation, and those are pretty much, we are not seeing any change from a structural trend. Of course, Q1, we all experienced a confluence of factors which came together, which whether you talk about the heat wave or you talk about the long election cycle, plus the fact that we had very few wedding nights in Q1. So I think in general that impacted, for all the hospitality companies, the revenue numbers, and that's visible in the Q1 results of the company. But I think, like we had also guided on our call and subsequently as well on various forums, we said that this is a temporary phenomena which we should come back in Q2 and subsequent quarters, and that's actually happened. As we speak, July has been very strong for most of the players. We benefited from significant pickup especially in the wedding activity on the MICE side. And the momentum has kind of continued in August with several of the convention centers, whether it's Bharat Mandapam or Yashobhumi, Geo in Bombay doing very well. And when one of these convention centers are doing an event, the city gets sold out. And if you take a little bit of if you zoom out and take a little bit of a India view, there are structural drivers which are out there, including things like the economic activity, which continues to be very robust at 6 to 7% growth. And there are various estimates out there, so 6.5, 7.5%, depending on whom you talk to. Plus, you're also seeing on the ground activity, whether you see global capability centers scaling up. The latest numbers I heard was that almost 100,000 plus employees will get added annually at the global capability centers. That's a large amount of employees getting high-paying jobs. If you talk about the manufacturing sector, there's a revival of sorts happening, especially on the high-tech side. So newer sectors, phones, batteries, semiconductors. All of this actually results in business travel coming into the country, and whether they land into Bombay, Bangalore, Delhi, etc., and then of course go to the ultimate destination, that becomes the sort of a big driver for sort of growth. And then on the leisure side, again, you talked about foreign tourist arrivals. I think we're just at the tip of the iceberg here. I mean, 90% of pre-COVID is actually not the benchmark. We should really think about when and how we should reach 2 to 3 times of what we have actually achieved pre-COVID. And there's no reason why the country cannot achieve that many tourists. Because if you look at some of the cities globally have attract 20, 25 million tourists. We are only talking about 9 and 10 right now. So again, and I think some of these things we think should actually improve in the next 18, 24 months because, firstly, some of the geopolitical situations we think should settle down in the next 1 or 2 years. We obviously don't know when that will happen, but the hope is that in the next couple of years, some of those things, the global conflicts or the regional conflicts should get resolved. Plus, I think the connectivity from India or various big cities to some of the cities in Europe and the US, the non-stop connectivity will only improve. It's actually not even back to COVID level if you look at the number of non-stop flights from India to different from the Indian metros to some of the destinations globally. So that's a big driver which we think will sort of happen in the next 12, 18 months as the large airlines in India start getting newer planes getting delivered. Hopefully that also improves the connectivity. Both, I think that's also an outbound impact, but also an inbound impact which will happen. And then, fundamentally, premiumization is a story which is here to stay. I think every year we get statistics about how many more households in India are actually earning, getting into the high income spend. There was a recent report by one of the brokerage houses. They talked about 50 million households getting added in the high income category in the next 5 years. So, and that's an annual phenomenon. So I think as we look at the sector, from Indian Hotels perspective, don't see any large challenges. Of course, there'll be quarterly blips here and there, but that is something which I think the industry sort of also got used to living with ups and downs, and then navigating those blips. And therefore, we feel reasonably confident that both 25 and 26 should actually do well. Keep in mind that FY24 we were coming out of a COVID year, so therefore, comparison with 24 is probably not the right way to think about it. But if you look at from 19 to 24, which is the 5-year window, if you look at the CAGR there, I think we should do better than the CAGR which was achieved in 1924 period.
Okay. So Ankur, very heartening to hear that you strongly feel that the trends that we saw in the Q1 is a mere one-time blip, and long term outlook is quite favorable. Any specific region or any specific segment you would like to shed light on, something which you see as being an outperformer in the near term? Any specific?
So, I mean, we did call out that in Q1, MICE got impacted, and we called out that, and I think that's true for the industry. And that's, of course, for the reasons we talked about. But I think, the good thing about India is that after a long time, a lot of things have got aligned as far as the country is concerned, whether it's just the macro environment or whether it's a geopolitical situation. And therefore, that is the big push from a business perspective. There is obviously the business segment which continues to do very well, and I think structurally the leisure segment, which is really the play on consumption and premiumization, that is got enough legs to run, if I can say, over the next 5 years, 6 years, because more and more people want to do more than one holiday in a year. So some people are saying that there is a trend towards people going abroad and doing a holiday, but that's fine. Let them go abroad, but they will also want to do something in India. So I think I mean it's hard to say that one will do better than other. But if you were to ask me, leisure is actually a segment which has a lot of legs to it. But business will always remain stable and will always provide the base on which we'll keep on growing at a steady rate.
Okay, great. So, Mr. Madan, now over to you, Mr. Madan. You broadly agree with Ankur's views that the long-term outlook is favorable for the industry.
Yeah. So, Mr. Majumdar, first of all, thanks for the opportunity to speak here, and thanks to CareEdge for putting together this very relevant topic, which we. So I agree, with what's been discussed, and also Ankur's view on the longer term. And I'll just, from InterGlobe perspective, just say that we see pretty strong, continue to see strong, robust growth. I think while Sunidhi shared overall macro trends, in the Indian market. Mr. Majumdar, this is, this industry is very micro market specific, i.e., where your hotels are, what the micro market is, what is your competition in the comp set, and what all is happening. For example, there's a pocket in Aero City in New Delhi where we have a presence, and we've seen fabulous increase there, and far more demand than supply. And while a lot of these parameters that we discussed, like at the moment, demand outstripping supply, etc., are relevant all across. But that's also an important factor. And also we have not really seen tier 2, tier 3 towns, and then some of the cities like Bangalore, Hyderabad, Pune still completely make up the lost grounds pre-COVID. So that's also yet to happen. From an international tourism perspective, Mr. Majumdar, still are living in a pretty disrupted world, if you really look at it. Because you have the Middle East situation, you have all the disruption going out there. The flights from China to India are disrupted, and these are kind of large airspace disruption. And it's not just about Middle East; it's about the ability to fly across transatlantic, and therefore, the reduction in the schedules of the major airlines. So there's a large part of that world that is still disrupted and not really available. And on top of it, if you really look at the demand supply gap in aviation, with the aircraft availability, where the airlines are not able to add the requisite capacity, which we have seen how it kind of, increased the overall yields in certain sectors, ultimately has an impact. And, even if you look at visa regime, that's still not completely neutralized to the pre-COVID level. So what we see, the resilience that, we have seen is actually, I have to say, the India story, because there are very few markets in the world that can more than catch up basis their home requirement when there are all these macro disruptions happening, which is a very important factor for the hotel industry, and that's not completely fructified. And I have to say also that the nature of demand and has also changed, Mr. Majumdar, pre-COVID to now, because the customers are more and more placing value on branded inventory. They are more looking at being more comfortable with organized hotels versus unorganized, simply because of the safety factor and the promise that the brand brings in terms of the experience they will have. And so customers are also making those trade-offs. And absolutely, pre-COVID, during the COVID time, a lot of inventory buildup got substantially reduced. And we will continue to see for a long period to come demand outstripping supply by 2x, i.e. supply being half of what the demand growth is. And that will also play up in the overall RevPAR growth. The other dimension, of course, is the government focus in terms of, promoting this industry. And also, Ankur also touched on this. See, the customer behavior is also changing. It's no longer about taking one longish holiday somewhere in Europe and be done with it. Now the trend is more about, and I don't know, it's possibly got something to do with COVID that's kind of rewired consumers' mind, where they just want to take multiple short vacations. And a lot of this is exploring your own country. And there is all of that resilience that is building up. It is a consistent, stable trend. And there are other additional pockets like MICE, which is a huge opportunity, because you really look at it, Mr. Majumdar, from the geographic lay of India. There is no reason why we should not be the regional transportation, regional aviation hub. And if that be the case, there is more and more convergence of consumers that we will see in this country. Also, if I may just may say, I mean, you really look at the number of hotel rooms per capita in India, and maybe I think Sunidhi will have the latest figures. We are by far the lowest, and I'm not even comparing with developed countries. And we have a large presence also as InterGlobe in Western Europe, where we have 13 hotels, and we launched our own brand named Miro. Recently, we launched in Paris, followed by Barcelona. But I'm not even comparing with those evolved market. I'm even comparing with some of the developing countries and our neighborhood countries. We are by far significantly lower. So I think that story will continue to play out. But having said that, the only caveat I'll have is that any black swan event happening, any disruption that happens, obviously, this industry is right at the forefront of disruption. We have seen this during COVID, and my only point there is that I think as businesses, we just need to run world-class businesses, top efficient businesses that have the resilience and that have the balance sheet strength to be able to cope with some of these situations, because these are blips. The businesses need to have that ability
So,
to.
Pankaj, the corollary to your argument would be that would you be expecting a further rise in occupancies for the current levels, and would you be willing to hazard some expected range for improvement in occupancies from the current levels?
Yeah. So, Mr. Majumdar, of course, and we cut it by, because the story by cities is very different. Even if I look at pre-COVID, and by micro markets is pretty different. And so there are, for example, Bangalore, we still see has a catch up to do. And with all this global capability center and the tech play coming up. We expect that over time it will catch up, but it's still somewhat lagging behind. But you look at, if we look at Delhi, we look at Mumbai, we look at Goa. We see pretty resilient growth.
Okay. So I have a question for you, Mr. Keswani. You have seen the industry over several years now, and we all know that hospitality is a sector which is cyclical. So how do you see the current trends? Do you agree with the other two participants that the current buoyant trends are going to last over a longer period of time? So what's your take on that?
So I will take it into two parts. One, I will try and give you an outside-in approach, because the two gentlemen before me have the data that they kind of track on a monthly basis, and they have to announce it. Here's my take. In the long term, as long as the world and general economic structure is stable, there is absolutely no doubt that hospitality should continue a hockey stick growth for the next many years. So but there's a rider to this whole thing. I think what we miss out on is, and I would advise, maybe that all of you can do a slice and dice, would be to say, look at the changes that you might be seeing, growth or otherwise, and how does it average out between same store, 2 to 3 years old store, and new store. Other than just the cluster of regions that you look at, and some surprising data might call out to you, because the averaging, unfortunately, in our business skews the data positively, because if I may forget the tier 1, tier 2 nomenclature, if I may say, what are the cash cow cities? Very little large supply can come out in the cash cow cities, because there are no sites available, and they won't be available at anything of a reasonable price for a very long time. So they skew the average rate and RevPAR data quite dramatically. The second thing is that as the growth is towards tier 2, tier 3, as the leisure locations come up, yes, you're seeing supply growth there. You're also seeing what is, loosely being called at COVID reaction revenge, But that is also, and I think people should go back and track what's happened the last 6 months. It is slowing down. It's slowing down for two reasons. One, weather has been unkind with all that, cloud bursts and everything else has happened. The second thing is that the growth of outbound, we are not factoring in. And the growth of outbound is growing in multiples actually. And that was a whole set of customers that were bound within India. And also immediately after COVID, visas were impossible to get for 8 months. 2 countries weren't visiting it. So if you were to imagine that our outbound was 12 to 14 million, I was just attending a seminar the other day and they expected to cross a 22 million mark. This was all the people who were, and they're growing in their economic stature. They want the shorter, better, easier, quicker, many more holidays. They are having the penchant to travel out. I think people should factor a little bit of a, canceling out of what our numbers are. 3, I think we concentrate and we talk about the foreign travelers. We are a long haul destination. So unless it's business, we are not doing very much to encourage leisure tour international traveler. The government now has shut down all their tourist offices. I think that's a tap we just, we waste our time on because no company has a wherewithal to go grow that market. And because it's long haul, plus then you've got an overflight problem, you've got issues with people even, reaching close by locations. India is far from that game. But the upper upscale and luxury hotels have for a long time been very dependent upon their high value customer, particularly in the metro cities, because that's where the traffic starts to move out to the other tourism locations. So I think multiple factors need to be taken into account. If you want to just put it into the summation of numbers, look, people say demand growth is 8 to 9%. It has always been, if you track backwards, it's always been in excess of 10. Earlier, we had a problem. Supply was growing at 5 or 6, then it dropped off, then it's growing now at 6 to 7. So as a cluster, as a summation, you have demand growing at 10 to 12. As a summation, you have supply growing at 8 to 9. So you've got this whole feeling, hey, it's business that's going to just boom. But maybe it won't boom beyond the average rate in the cash cow locations, but it will grow in the gross revenues because it's getting spread to a lot more other locations. And then you're going to track how those locations are going to behave over a trend. Long term, all this, as I said, international, whatever's happening in the world, economically and otherwise, if that stabilizes, there is no doubt about the hockey stick. And I had predicted to some press in April and May that this summer is not going to be great. And everybody's comparing it, unfortunately, last year. Last year, you had a lot of large events. There are no such large events in this country, even in the winter. Last year was also a very, very big year for weddings in terms of dates. Yeah, weddings happen all the time in India. This year, the number of dates of those weddings are lesser than last year. So to say it will therefore grow at that quantum, I am unsure about it. I had kind of predicted somebody that this summer, early autumn might be a little lower than expectation. I would temper my responses again for half H2. However, as I said, largely the growth is substantive. It will always happen, but do decluster and to take it into certain regional location, new supply versus old supply versus some supply that's come in from each of the chains and otherwise in the last 2-3 years. And that will give you much more of a robust data bank to assess it in multiple other, buckets rather than the big picture, which is gross revenue and everybody's doing very well. That will be my advice to everybody.
Okay. Thank you. That's an interesting perspective. Now, I would like to move towards the supply side, having, taken some questions on the having had some very useful inputs on the demand side. My question to you, Mr. Dalwani, how strong is the pipeline looking when we talk from a medium term perspective, let's say 2 to 3 years? Currently, of course, demand is outpacing supply. But what happens when we hit 26, 27? Are we expecting another round of supply demand mismatch? And how does it break up between tier 1 and tier 2 cities? The supply demand balances?
I think I think this has been talked about in various forums that, supply is lagging behind demand. But I think 2 points made by Pankaj and Rattan, it's again a very micro market analysis. It's not, obviously the amount of supply you're going to see in the top 8 cities is going to be very limited because you are not going to have that much of land itself available for sort of setting up hotels. Plus, it's obviously more difficult to construct in the larger cities just because of the norms which are out there on construction timeline, etc. So I think various people have talked about, if you talk to consultants, you get estimates ranging from 6 to 8%, and on depending on the time frame. I think that's pretty much a right number to think about. But I also think that the announcements are actually far larger. If you look at what the people have come out and said, that we will be X number of hotels by Y years. If you add up all those X's and add it up, it turns out to be a very large number. But the reality in India, sorry, Rattan, you have a point to make?
Sorry, I'm just going to give an aside. Mr. Oberoi used to say to us, announcements are for free. Let's see how much comes in. So sorry, I just had a, quotable.
Yeah, no, absolutely. So that's the point I was trying to make, that, it's easy to make announcement, but actually in India, all the supply, I would say substantial, maybe even 95% of supply is greenfield or brownfield construction. They are not conversions. So, somebody has to go and build. It's not, it's not a, global chain who's not building it, but some owner is building it, right? Similarly, if we are not building it, some owner is building it, or if, in some other companies who are listed are also building it themselves. The construction period in India, as you know, is not less than 3 to 5 years, depending on the city you pick, depending on the location. And then if you're lucky and everything goes as per schedule. But, as you know, life is not a straight line, and there are always sort of, air pockets we get into, especially if you're building projects all over the country. So in general, I think that's how I'm thinking about supply, and it will always going to be, all the new supply is going to come, or large portion, maybe 65-70% of that is going to come in markets which are outside the core markets. These are the top 7-8 metros, Goa, and maybe one more of the core leisure markets. So if you were to exclude these 10 markets, then that's where most of the supply is coming. Now, that does two things. It sometimes, supply also creates its own demand. When you have, when you have currently you have 0 hotels or 1 hotel in a location, but suddenly you have 2 or 3 hotels come opening up in 4 or 5 years, you actually start seeing more of the demand also come into that market, saying that, okay, now instead of, let's say, going to the state capital, we can do function in the city itself, because now there are 3 options to choose from. So some of that actually also is going to play out as we think about demand supply and the dynamics of demand supply in the next 3 to 5 years. So I think that's our view. Also, if you look at the luxury end of or the upper upscale end of the segment, again, very limited supply. It's probably going to be luxury, is probably even going to be single-digit numbers. And if you were to add, sort of the upper upscale, it's probably we are talking about 18-20% of the projected supply. So a lot of the supply is going to come up in the sort of the mid-scale or the economy in the budget segment.
Yeah. So in fact, that was, the subject of my next question to Mr. Madan. In fact, that was something that is planned to address to him. As we have seen in our own presentation, we see that there is likely to be a mix. I mean, the overall mix is likely to pivot away from the luxury and upper upscale, segment to the upper mid-scale and the mid-scale economy segment. So do you also, share the same view, or you have a different view on this in terms of the mix?
So, Mr. Majumdar, if you really look at what's happening today, I mean, in 2024, out of the 6,000 new keys that have been added, only 15% is in tier 1, which is a very small percentage. And over the last few years, if you look at on an average, 45% of the supplies come in also in mid to upper mid scale. And if you look at over the next 3 years, what's going to happen is this 45% becomes 55%. And I think that's got to do with not necessarily entirely driven by the supply chasing the demand, but it's also about just the ability and affordability and of where, these hotels can come up. Because I think the larger issue we also have is just the cost of putting a hotel together. Look at the cost of land, look at the cost of construction, look at inflation, look at the high cost of financing, look at the multiple regulations and compliances and licenses that the industry has to deal with. And and there could be more that can happen from government in terms of kind of the tax efficiency structurally in constructing and putting these hotels together. So and it's all of that which plays ultimately into where the supply comes up. Eventually what will happen therefore is, it's not that structurally there is anything amiss in demand in tier 1 towns, but what's going to happen over time is that the gap between demand and supply in tier 1 will expand even further, which would then kind of trigger the commercial justification rationale to put in more inventory there. And of course, for a large part, businesses that had the vision and that have those assets already, they see the benefit. I mean, of a very significant growth, will continue to see that. And I think, but having said that, even if we have supply coming in mid upper middle scale, it's a good story. This is India resilience. And one comment which is a very valid comment actually also on that there is the outbound tourism is increasing, and we also see that. But I think going back to the India resilience story, what's also happening is that people are trading up, and and consumers who were even in the lower end of hierarchy, where they were not even taking holidays, are now able to do so, and therefore that gap gradually is also getting filled up. When I also look at it, with the same story plays out when I look at from aviation point of view. At group we have business Indigo Airlines, is that wherever we put up capacity, the demand just follows. It just fills it up, and so yeah, I think broadly I agree.
So the key takeaway, as I see from all of you, is that new capacities are going to come up, maybe in the tier 2 and tier 3 cities. The new travelers are going to come from these cities. Maybe people who were not earlier being a part of these hotel chains. I mean, probably unorganized hotels, or probably not even taking vacations regularly. So now they are going to trade up and move into this economy kind of segment. So that's going to grow the overall business. It's not that the premium and the upper scale is going to decline or anything. They are going to keep growing at a smaller pace, but there'll be this huge addition which is going to come in the mid. So if I have understood correct.
Right.
So my question then, somewhat apart from just the supply side, is to Mr. Keswani. A lot of signings are happening on the management contract side. So what, in your view, is a healthy mix between ownership and management contracts, especially when you talk about the Indian context?
Okay, so there is no theoretical model, unfortunately.
Okay.
And I think Ankur and Pankaj would be able to give you what they believe it should be. Again, now I can speak from the outside. I think you need to have at least 20 to 25% of the ownership of the company, of large hotels belong to you. But also, this is of a new business, so you have to set your brand. Give the brand a little bit of an identity, and therefore you must have your own hotels. But there's a whole risk in the timeline and risking capital in the return that you can get if you continue to build your own. One, there's a timeline. Two, therefore, the expectation of return based on ROC and otherwise. There is a higher risk in continuing to follow that model. So if I was to kind of hazard a guess, I'd say 25 to 35% should be owned up to a top of about 20. Another 30 to 40 should be managed hotels, and maybe the balance can be franchised. That's how large companies have grown worldwide for the last 60, 70 years. The only limitation towards the higher range between franchise that I would kind of, warn people about, and a lot of the bigger brands have tried franchising, pulled out, tried again, third party, pulled out, is because our legal structures for our management contract, franchise contracts, you can create any kind of a document, but are they really compliant enough? Are they really going to be followed? Owners can just take you to court and they can sit there. The risk to the brand is very high. And in India, to find any diligent, compliant information about future partners is extremely difficult. I would actually say pretty much impossible as you grow to the tier 2, tier 3 cities. So are you willing to risk your brand? Are you willing to risk, compliances? Are you willing to risk team and guess to, the gaps that might come in while you're having a controversy? But what I've given the numbers is the worldwide model, is how it normally works. And it's been a bit of a shifty one. Even when the international brands started to come in, they did chase franchise a lot. They stalled it for a number of years. And now I see again that some of them have paced up their activity. And of course, Wyndham's doing, have a lot more. Lemon Tree's now started themselves. So yeah, it's a changing field, but a safe mix, if the legal compliances could be better, would be the numbers that I've talked about.
Thanks.
Got that. I would now like to come in over here, and those insights from you on the demand and supply side were very interesting. We'll stick with you, Mr. Keswani, since you were sharing your thoughts. Maybe how companies take advantage of this cycle, which we are currently, is left to the individual strategies of the company. But out of your own experience, do you feel there is more to do on the revenue management by the hoteliers beyond the cookie cutter model so that the growth cycle kind of sustains?
I think the airline guys, and maybe Pankaj should answer this question, make our life difficult because as much as hoteliers do on revenue management skills, they're always found to be short and wanting because there's an opinion. Okay. Again, these models work depending upon how tight your segments are. In India, the segments are very large, and your dependence on direct sell purely because Indians are how they are, skews this whole business, because then you have to sign large contracts and they don't seem to be relevant, but they are relationship oriented with the brand, as Ankur would tell you. I think because there is a science that can be, dealt with now, with a lot of the improvements in automation and AI, I think everybody is doing a great job now. It's improved dramatically in just the last 5 years that I've seen. As we've gone through multiple cycles in the last 15 odd years. And so, revenue management is one most extremely important part. Two, the second thing is, I'm not too sure we are taking away some of the irritants that we have in our systems, which is where tech comes in, but then tech becomes, a lot more expensive for a smaller player to be able to invest and therefore get a yield on. I don't think too much gets invested if I cluster all the brands together on the branding exercise, which therefore, kills the logic of what is loyalty. Is there loyalty? Does that what's the difference? The third biggest, how should I say it, elephant in the room is the online distribution channels, right? They're there to stay. Yeah, and every hotelier, behind closed door will complain. Of course, they'll kiss and hug them whenever they meet them. They are today, and not so much for the, Ankur is smiling, not in the larger, more, upscale and luxury hotels. I think they contribute about 10 to 12 or 15% of their business. But if you go down the scale, online's creating almost 35 upwards to 45, if not more, of the business. That's a high cost business, maybe lesser cost than setting up your own distribution systems. And so what is happening is that you are losing control of your customer. So whatever you do for loyalty, whatever you do for brand, you get consumed by this elephant. So, that's where the doubts come in as to what's the right way. And then that affects your revenue management because it has to be clustered on value chains. So it's a bit of a complicated piece that everybody needs to look at. And there are too many segments that we are not able to reach out to and get the best yield for. And then it gets even worse in the mid scale and the lower scale, because a typical Indian habit saying deal hai kya, and if deal nahi hai to we'll go online, and then the online crashes it. So that's the reality. And so hoteliers need to find a way out of that reality to be able to put themselves in the face and give every kind of segment or every kind of age group an essence of what they are looking for differently. And that's another place, in my opinion, where micro segmentation is not being understood or analyzed. That would create a lot of benefits as you go tier 2, tier 3 cities, as you go into customization of locations for customization of experiences. You'll have to hone this down to a different skill. You have the tech availability, but you've got to learn how to work that tech to get you the right businesses. Because there are lots of different requirements that a classical hotelier will still hesitate to delve in or invest in. And then you've got a techie whose language is not being understood, but maybe you need to go to the customer. And the age group of the customer, this whole thing about Gen Z, Boomer, Millennium, need to go into a little bit more, because that will define the way for the future. The business will work here, the 5, 8 tier 1 cities will work perfectly, but the rest of it will have to be micro experiences, micro segmentation, therefore leading to better revenue management, or then you will lose them to close by, easier to reach, cheaper locations, which give that value chain, which is again limited at our end. And then we also have the hygiene safety issues that put everything into the back.
Sure. Yeah.
So again, like I said, for analyzing businesses, demand, how to handle demand, how to segment, also has to be put in clusters of location and purpose of that location, and then clusters and segments of this newer customer who's able to spend more, but their needs and thinking is different. A lot of what we do is still being done in a classical mode, which still leaves some of our older hoteliers relevant and still important for opinions, but that's not what the customer is looking for. That's my humble opinion.
Sure, got it. Those were interesting inputs. I would now like to get in Mr. Dalwani over here. What is your pick on the same piece? And also, since we've spoken of the demand and the supply, maybe from an industry perspective, what are the RevPARs are you seeing grow beyond the immediate medium? Because 25 looks positive. So maybe, how do you see 26, 27 going from over here?
So I think on revenue management, I think Mr. Keswani has given very interesting insights and points, and I agree with that. So without spending more time on it, let me talk a little bit on RevPAR's outlook. I think on RevPAR's, I think frankly, it's we're all used to maybe looking at 20% or high double-digit growth, which happened in FY24 and FY23. But like I said earlier in my one of the earlier questions, that you have to look at a period, and I think if you look at maybe 19 to 24 or 18 to 24, you'll see that how RevPARs grow typically in an upcycle is that you end up passing on your cost inflation and something extra, so your margins expand then, right? So I think that's the cycle we are in. We are in an upcycle, maybe early part of an upcycle, or maybe early to mid part of the cycle, where we should see this momentum continue, where we are able to pass on inflation plus and certain premium on inflation, so that we recover the cost and also the margin expand. I think that's generally the view. But again, it's real estate, it's a location, and therefore micro market will make a difference. Pankaj was talking about how AeroCity is doing so well, and we wish we had more hotels there. We have something there, but that's something which is doing that kind of a macro market, for example, is doing really well. Similarly, if you look at South Bombay or Bandra or BKC markets, those are doing extremely well, right? So depending on, again, which micro market you pick, the RevPAR will vary. But I think in general, the direction seems to be that we should be able to pass through cost. If you look at the industry RevPAR, they're still low. I mean, 4,500, 5,000 rupees RevPARs. I mean, that's for the industry as a whole, which includes all the category. That is nothing compared to if you see any part of the world, developed, if you look at benchmarks. And therefore, if you look at the industry, there's obviously more room to grow. And this is how we are thinking about this.
Sure. So basically, on an average, we are saying that there is still more steam left beyond 25 if we look, and we see RevPARs growing in a double digit. I mean, obviously, the gateway cities might grow since there is less supply coming over there, and they might grow at a higher rate. But otherwise, also tier 2 and tier 3 would be having that growth, but there is more steam left in for the growth to happen.
It will be cost plus led. So I think, if your costs are growing at 7-8%, you should be able to pass on that much, and maybe even slightly more than that.
Okay, got that. We move on to you, Mr. Madan. The industry has shown its resilience. We call 21 as a survival year, 22 was the revival, then 23, 24 were the growth years for the sector. Players have been reporting their decadal high revenues and profitabilities. What are the tailwinds and the headwinds that you see? I mean, you spoke about the per capita income increase, the regional travel, the tourism package, but any other picks, any large, say two or three tailwinds and headwinds that you see for the sector?
Yeah, so Ravleen, I think, if you look at the tailwinds, just I think emerging from COVID, simply because the supply slowed down and demand is 2x of what the supply is and will remain so for the next few years to come, because the kind of building up the pipeline and delivering is a 3.5 year proposition. So that catch up will take a long time to come, and that's clearly the tailwind that the industry currently is experiencing. Also, is just the change in consumer mindset, where there's a kind of a pretty significant change in just the leisure consumer from pre-COVID to now. And while maybe there's a tad bit of COVID revenge travel that was embedded in there, but I have to believe there's a small fraction, because for the majority, we see the resilience of the demand continue. So the other factor, as I just talked about a bit earlier, is that there is so much disruption at the global scale, with the Middle East war, with the China flights not there, and so on. When some of these open up, that could be a significant increase in international tourism as well. I think in terms of, and the other one, of course, is that particularly on tier 1, the supply is even lower. Now, I think, and the economy is doing well. I have no reasons to believe that there are any kind of, concerns as such, when you look at it, and that will continue to fuel the overall, demand in the industry. But I mean, in terms of the headwinds, any disruption happens, domestic, overseas, obviously has an implication, and those are the things you cannot predict. There's this issue about, for example, the monkeypox being a global pandemic declared by WHO. Seems it's under control at the moment. When some of these things flare up and start having a cascading impact all across, those are the kind of issues that the industry has to be wary of, and that can, Ravleen, of course, impact the business.
Sure, we got that. Thank you. And in the view of the time, we will just move to the Q&A session. A few participants have already keyed in their queries. Now, for the rest of the participants,
make one
sure, please.
I think the industry at large needs to watch out very seriously and plan for it, which is the talent crunch.
Correct.
As much as you are putting in inventory, you don't have the right people wanting to work with you. We continue to treat the employee as a operational expense, and therefore expenses need to be brought down or whatever. I think our whole mindset needs to change. We need to find another way of finding better people and then training them. I do a lot of training sessions at the multiple institutes, and even at the catering college and the hospitality management institute. You'd be shocked that even though they're on their 3rd and 4th years, not more than 20% see themselves staying with hospitality after they pass out, because their personality is grown, their education is grown, but 80% feel that they will find a better substantive role in another industry. Now, that's a huge problem, because you may want better rates and you may want to keep on, putting the supply. You're going into tier 2, tier 3, and we're not vocationalizing our jobs. Who's going to do them? That's going to affect standards. Standards affect rates. So it's a bit of a conundrum that hasn't been solved for a couple of years. I think as an industry at large, that needs to be taken into account very, very seriously before it catches up on it. It already is. And I'm seeing it, but I would just hope people would do for their, their business is the right thing.
No, we know that. Even I was hearing in one of the webinars that, we have a very good top layer or maybe the top 2 layers. But the layers beyond that, we need to maybe invest more in training and these sessions. We note that. We have few questions, from the from our audience, and maybe I'll direct the first one to Mr. Dalwani. One of our participants is asking that, do you see the unbranded space, or how we call like the non-traditional brands like OYO and Airbnb, as a potential competition to you? To the branded hotel space in industry? Are they eating up into your occupancies a bit? Or how, or maybe, what we feel or what we discuss in few webinars and discussions is, maybe they help you penetrate the market, and they are like, because that customer then moves up the ladder to a branded space. So what's your take on that?
No, I think that's a question which has been there globally, not only in India, because Airbnb came many years before OYO came. But I think the point is that these are two distinct businesses and two distinct segments. I mean, when you look at hospitality, you're really looking at, it's more of a service business where you're looking at an experience, versus if you look at a sort of a OYO or Airbnb model, that's more of a shelter business, right? You're looking for shelter. So I think these are two distinct markets, two distinct sort of business models, and not necessarily competing, but complementing each other. I think, like you said, today's one customers can become customer of the other depending on their requirements. And then, given the size of the country, the heterogeneity, and some of the points we discussed as a panel about the demographics, etc. There is, I think, it's not a winner take all market. It's not that you have only only hotels which have to do well. I think in general in this uptrend, even your sort of homestays, etc., would also do well, and I think that's a trend which is there. We have to keep in mind that how the regulatory landscape evolves for some of these businesses, especially if you look at what's happened in the West, and then that's something to watch out. Also, as these models become more mature, there are costs which get associated with the sort of the stay.
Sure.
Like, for example, in the US, there is Airbnb clearing fee, etc., and all of that, which can actually be higher than the your stay charges in some cases. So I think some of those things also will evolve as the business models mature for some of these industries.
Got that.
So
and I think we see
imminently, we
more
don't
of
think it's an
demand from
imminent.
that segment. Sure.
So I'm just saying that it's not something which we think is going to eat into our demand in the next foreseeable future.
Sure. Got that. The only point I was making is that I think the demand from that segment is more into the leisure. Any which ways, the business people would probably not go into that section, because
Yeah, so
that is
again,
where the people get.
You're right, absolutely. That is one segment. And again, in leisure, there are, whether it's aspirational, whether, what kind of luxury you're going after, etc. So, it definitely doesn't impact someone like us, but maybe even from the industry perspective, I don't think it's a big sort of challenge.
Sure. Got that. I'll direct the next one to you, Mr. Keswani, since you were talking about the OTAs. Somebody is talking of the penetration of the OTAs. I think currently in India, it's obviously lower, maybe 15, 16%. And in developed nations, it is much higher, maybe to the north of 35, 40%. Do you feel in the past these platforms have somewhat, have a role to play to the depressed hospitality rates? Since, there's a huge competition out, and, the customer only goes to picking up a best deal. So what's your take on that?
So the person is right. As a cluster, again, not looking at upper upscale, these separations, I believe Europe is up to about 37, upwards of 42% on bookings being driven from online. But what is different there is that the online abroad has matured, and they are not so much into slash bar pricing as it is in India. So it's a bit of a changing segment as I see it. Everybody, including the customer and all of us, need to understand it gave us distribution bandwidth, which just physically by putting in sales offices was just too expensive. So we've got to reward them for what they've done. Could they charge less? Yes. That's everybody wants to be charged less for the cost of doing business. At the same time, if you work with the online company and you allow certain models and packages to work, you get what you have given them as a rate to work with. If they reduce that rate, that cost is borne by them. So if you don't know how to manage your rates, your bar rates at the online piece, and you're depressing it yourself, that's your fault. You can actually load your bar rate and then you pay them the commission based on that bar rate, as long as your bar rate is rightly priced and you find the other way to do your own. But because people think that because Slash Bar is there, it helps their buying decision because they're getting the hotel cheaper on the portal. But that doesn't mean that the hotel's effective average rate or that is being effective. Of course, the step down effect comes in the P&L on the operational expenses, the commission that you pay. There is no ready answer for it. But if you now go back to how has Expedia moved, how has Booking.com moved, they have gone away from the factor of Slash Bar rates. Because again, the market's mature, people look for it differently. In our country, we look for that piece, plus we look for flight and hotels as what is called F&H in our business, as a cluster together, which of course a hotel cannot battle. So if you get a cluster rate, which includes flight and hotel, and now they've gone into all other trades as well, you get what you want. But then as far as the customer is concerned, that drives the customer preference again to their side. But that's the nature of the beast. You've got to live with it. You've got to negotiate with them, and you've got to find where on your websites and on your direct distribution, how can you package to still get an equal to, if not better yield? Because that's where you'll save the money. And how do you attract the customer directly, which again needs bandwidth of distribution and marketing. Not too many people have solved that as much. So they still receive it the way it is.
Got that. And maybe the last one, Pankaj, I'll direct to you, since you, basically this participant wants to understand how's the RevPAR growth in India versus the top 10 or 15 tourism countries. Maybe not top, but since you have operations in UK and otherwise as well, maybe you can tell us how's the RevPAR growth in India versus there.
Ravleen, different markets, and within, if I look at the international portfolio, we, have assets there where the nature of the assets also somewhat different. For example, we have one of our hotels is the Sheraton at Schiphol Airport, and that captures obviously, it's an airport hotel, and so it has its own dynamics. So pretty stable, sound, robust growth in RevPAR. I think a lot of these are also not so much trend related, but what you do to the asset, and that particular asset. Just to using that as an example, it has an I think the top-notch location in Amsterdam. But what we did during COVID is that we used the disruption that was happening already and utilized that time to upgrade it, refurbish it, and therefore we see that asset being very well positioned to capture the market. And likewise, our assets in Paris or Barcelona, London, and Vienna, we are kind of, we have already delivered on Paris and on Barcelona, but London still will be delivered in early next year, is where we are upgrading the asset to luxury, boutique luxury experience. And that is what is driving, the overall RevPAR growth. Of course, the market will do what the market would do. The location is crucial, and that's just the initial go-to-market hypothesis when we get into those assets, because that's something you cannot change. But other than that, macro dynamics will play out, sometime for you, sometimes against you. And then comes the asset management, the revenue management, and what you do with the property that then drives the output. Now,
Sure.
what is unique in Europe, of course, is I think inflation is a larger issue, compared to what is in India, but the demand continues to be very robust.
Got that. In the positive of the time, I think we'll have to end the questions over here. We had a great time moderating this wonderful panel, and I now hand over to you, Mamta, maybe for closing the session. Over to you.
Thank you, Ravleen and Sabyasachi, for moderating this session, and Sunidhi for your presentation. Once again, thanking all our guest speakers for their insightful views. It was a privilege to host you. And lastly, thank you to all the participants for taking the time out and being a part of this CareEdge webinar. For any further queries, feedback, or suggestions, please write to us in the feedback mail. Goodbye for now. Requesting the tech team to kindly log off.
Great. Thank you, everyone. Thank you.